I'm Tyler Sovey, and I'll be presenting today on FASB 160, Non-Controlling Interest. Non-controlling interest is described as the portion of equity in a subsidiary not attributable to the parent company. This FASB describes owners as shareholders, firms, partners, etc., and it describes a subsidiary as an entity including an unincorporated entity such as a partnership. So for this unit, we can assume that a subsidiary, the company that is being acquired by the parent company, can be a partnership, and the non-controlling interest can be owned by owners, one of which could be a partner of a partnership. This FASB also changes previous standards by renaming minority interest to non-controlling interest to give it a broader scope, and it requires that non-controlling interest is listed as a separate line item under the equity section of the consolidated balance sheet. This FASB and topic specifically are introduced in Chapter 3 of our textbook. In this problem, Company A, the parent, is buying 80% of Company B. Again, this could refer to a partnership for $688,000. However, the fair value of the non-controlling interest is estimated to be $160,000. The account balances of Corporation B can be seen here on the right. This problem also includes a few fair value adjustments. What these are the differences between the book and fair value of the assets and liabilities of the subsidiary. We're going to start this problem with some calculations. First of all, to find the implied value of the corporation that we're acquiring, we take $688,000 divided by 0.8, the percentage that we are acquiring, which will give us $860,000. According to our purchase price, this is going to be what the implied 100% of the firm would be if 80% is $688,000. Next, we have the normal non-controlling interest if we are not given the independently assumed amount. To find that, we would take the 100%, $860,000, subtract the purchase price to get $172,000. However, in this problem, we are told that the non-controlling interest is less than what it is assumed to be based off the purchase price. We are told that it is actually $160,000. Lastly, to calculate the net assets fair value, we take the fair value of the assets, $920,000, and subtract the fair value of the liabilities, $160,000, to get $760,000. This is our value analysis. On the top, we have the value analysis if we do the regular calculation without the new non-controlling interest, and on the bottom we have the same table but with the adjusted non-controlling interest. So on the top, we have the implied fair value of the subsidiary. That is 688 divided by 0.8. That's what we got in the previous slide. Below that, we have the fair value of the assets, of the net assets. This is what we did in the previous slide, fair value assets minus fair value liabilities, that's 760. Then we have 100,000 for goodwill, which is 860,000 minus 760,000. Then one column to the right, we have these numbers times 80%, and then one more, we have those numbers times 20%. However, in this problem, we are told that the non-controlling interest is not 172, it is actually 160. We have evidence to assume that it is actually 160. So this is going to change a few things in this problem. First of all, the implied fair value of the subsidiary is going to be the parent share plus the non-controlling interest share. So this will go down from $860 to $848,000. The fair value of the assets is not going to change. That's not affected by non-controlling interest. But the goodwill is going to change because that is affected by the subsidiary's fair value, as well as the non-controlling interest goodwill, which is affected by the non-controlling interest. Here we have a determination and distribution schedule. First, by the blue arrows here, we have the book values of the equity of the firm. Totals can be found in the total equity row. Then we have the percent acquired, basically just the 80%, 20% of the parent and the subsidiary. So then the book value of the parent share, 80%, is 268. That is 335 times 80%. And then we have the non-controlling interest share here of the book value, which is 67. Then we have the excess of the fair value over the book value. That's these right here. Basically, it's going to be the fair values up here minus the book values, and we get these right here. We can also find the total fair value over book value excess right here using the adjustments that we also were given. So if you add these up and then add the goodwill here of 88, we saw that in the slide with the normal and adjusted non-controlling interest tables, you also get this 513, which is the total excess fair value over the book value. So first of all, we're going to perform 3 journal entries to finish up this problem. The first one is to eliminate the investment in S before we get to the non-controlling interest again. So to do that, we're basically aiming to eliminate the $688,000 purchase price. To do that, we are going to credit the parent share of the fair value over book value, and we're going to also credit the parent share of the equity book value. So basically, we are crediting the parent's share, the 80% of the excess fair value over book value, as well as 80% of the book value of the equity of the subsidiary. The second journal entry is to eliminate 80% of the subsidiary's equity. To do that, we're going to debit 80% of each of the subsidiary's equity accounts. So 80% of common stock, 80% of additional paid in capital, and 80% of retained earnings. This is going to equal $268,000, which is the parent share, 80% of the equity book value. So now we're going to deal with the part of the problem that handles FASB 160. So we have a remaining $93,000 of the non-controlling interests excess fair value over book value that we need to get rid of or allocate. So to allocate this amount, we are going to credit retained earnings for the 20% adjusted non-controlling interest excess fair value over book value. For my sources, I have an article from the Journal of Accountancy, and I have the video that described and explained this problem and subject.